Guys, I have some very important news that I could not absolutely wait to share. I refuse to be silent. But before we get into this, make sure you like, comment, subscribe. The value I bring to you guys is housing market updates. We're on the road to 100 subscribers. This may sound off topic, but no, it correlates with home prices declining. This is something that is actually starting to show with the banks. Wells Fargo, for example, is starting to lay off its employees. Little more than a week after reporting mortgage origination, volume had dropped 33% year over year, the bank confirmed to Business Insider and American Banker. This was blamed in a decrease of refinance activity and also a rise in higher interest rates. The average interest rates accompanying 30-year fixed rate mortgages has risen above 5%. This has been the most it's been since 2010. Wells Fargo is not the only business laying people off. The largest lender in the mortgage industry, Rocket, is looking to trim its workforce following 2 years of record loan volume. Detroit-based Rocket Mortgage and Amrock, its title company, offering voluntary buyouts to 8% of its workforce. Officials reported on Monday Rocket companies, including Rocket Mortgage, employ approximately 26,000 people, mostly in Detroit. The buyer program was first reported by Crane's Detroit Business. The affected employees were primarily in Rocket's mortgage operation teams and at various groups within Amrock. A Rocket spokesperson framed it as an opportunity to voluntarily accept a career transition incentive. Guys, I don't know, it's starting to look really bleak. Let's take a look into mortgage refinances and see how much have they dropped. As you guys can see, mortgage refinances has completely tumbled. From February 6th, this was like one of the highest, and then it just dropped. Once the interest rates rose up, it just dropped like crazy. But that's just common sense. You're not going to refinance your home with a higher interest rate. And this is why I figure a housing market crash is going to happen. A lot of people say that lending practices are better than it once was, but there's more ways to get into a car crash. And what I mean by that analogy is that there's more ways for a housing crash to happen. So what's going to happen is, since banks are starting to lay off employees, that means the demand for mortgages is getting down. That means less competition is going to be on the housing market. But if there's less competition on the housing market, yeah, that's good for the buyers. But it's not, because there's not enough inventory at the same time. So what I think is going to happen is people are going to move into renting. But a good thing is America has been building the most it has ever built. And once these houses hit the market, these homes that are bought by these wealthy investors will decrease in value because there's other homes to look out for. And you can see a mass sell-off of homes because, they don't want to, they're trying to get their rate of return, but some of them is going to be too late. I'm going to show you guys even more data that shows home sales are actually slowing down. Existing home sales in the U.S. fell 2.7% to a seasonally adjusted annualized rate of 5.7 million in March of 2022, the lowest since June of 2020. It is the second consecutive month of fall in home sales as the housing market starts to feel the impact of rising interest rate and inflation. And guys, the inventory of existing homes increased to 950,000. That would support roughly 2.0 months of inventory if we continued at that sales price. Now, let's compare something actually. As you guys can see, 2021 existing housing inventory was higher than 2022. Well, in the first few months, it is still higher. But once the higher interest rates got introduced, which took effect, I think it got effect into February, but March is when it started really to hit into effect. We had a roughly a 10% increase. But let's look at another metric that honestly will kind of have you surprised. So this is pending home sales data. And for the past 10 consecutive months, it has been down. As you guys don't know, pending home sales is based on signed real estate contracts. When a seller accepts a sales contract on a property, it is then recorded into the MLS and then regarded as a pending home sale. And guys, I have nothing against you guys choosing to buy. People have different circumstances in life. If this don't apply to you, you don't have to listen to what I'm saying. Everybody has different situations that must they attend to. Buy, I'll say only buy if you absolutely have to. But the reason why I say hold off on buying, because the feds are already planning to raise interest rates even more. The interest rates as of right now is 5.42. Historically, this is pretty average, but this is going to only increase because the feds have meetup dates in May and June, and they're supposed to increase the federal funds rate back to back, half points back to back each meeting. So I'm just saying, guys, you're gonna see some pretty much higher, probably more than average mortgage rates, and this can crash the market because not too many people will be able to afford those mortgage rates anyway. I like to always equivalent this like basically like before a Black Friday sale. You bought before a Black Friday sale, because all these other real estate investors, they own 20 million of the US homes. So they own a good amount, and they own 20 to 25%. So that is a record high number. And it may not seem too much, but it's increasingly high. So once those homes sell, it's going to be like homes galore. Now, guys, you have to be careful with the mainstream media. Of course, they're going to tell you, oh, it's the perfect time to buy. This is the perfect economy. Guys, this is not the perfect economy to buy at all. You follow their advice, you end up buying a house 100K over the asking price. And then when the market gets healthy, and also due to conformity, all the other houses are going to decrease in value along with your house. So that, say for instance, you paid let's say the house was originally supposed to be worth 350K, but you paid 150K over the asking price, and now it's 500. The house you bought was for 500K, but it just depreciates because of conformity, and then there's other houses on the market. So that equity is going to have a negative loss to it. Some of these housing markets that had 50% appreciation is not sustainable at all. A drop will have to occur. The mainstream media is not keeping it real. A recession is near. I read a book called The Changing World Order by Ray Dalio. I think called Dalio. My bad if I messed it up. But a lot of things that is happening in this housing market and the economy is stay true to this book. We have devalued the dollar purchasing power by 8.5%. People wages haven't been caught up nowhere near that, in fact. Rent in Miami has appreciated to 57%. The middle class is the backbone of this country. So the thing is, the gap between the rich and middle class can only be so far apart. There's only so much the government can exploit. They have to, quote unquote, reset the economy. And this goes back to 1980 to 1981. Somewhere around those years, inflation has reached maybe 14%, 15%. Paul Volcker, the federal Fed chair at the time, had to raise interest rates up to very high rates, and then to reset the economy, get inflation out the mix. And then, it led to a pretty big outrage, but it needed to be done for the economy to move on. This is going to be the end of the video. Make sure you like, comment, and subscribe.